Hey there, history buffs. Imagine dimly lit rooms where shadows dance on the walls. Heavy mahogany tables dominate the space, exuding an air of authority and tradition. Around these tables, powerful figures huddle, their faces etched with concentration. They speak in hushed tones about money and power, their words shaping the future of economies. This is the image often conjured when we think of old banking families like the Rothschilds, who wielded immense influence. It's an image steeped in mystery and intrigue, a world hidden from the public eye. But the world of finance has evolved dramatically over the years. Today, central banks operate in the full light of day. They are complex institutions with vast responsibilities. However, they are subject to public scrutiny and democratic oversight, ensuring transparency. The transition from shadowy family dynasties to transparent central banks marks a significant shift in financial governance. It's a shift toward accountability and public trust, a move towards a more open financial system. Understanding this evolution requires us to delve into the rich history of central banking. We must separate fact from fiction, uncovering the true narrative behind these institutions. Only then can we appreciate the crucial role central banks play in our modern economies, guiding us through financial complexities. The concept of a central bank emerged gradually over centuries. It arose from the need for financial stability and the desire to prevent economic crises. One of the earliest pioneers in this field was Sweden's Riksbank. Established in 1668, the Riksbank introduced many features we associate with central banks today. These include issuing banknotes and acting as a lender of last resort to commercial banks, ensuring liquidity in times of need. Across the North Sea, the Bank of England followed suit in 1694, marking another significant milestone. The Bank of England was initially a private institution created to fund the government. However, it quickly assumed a central role in managing England's finances, becoming indispensable. These early central banks laid the foundation for a new era in finance, setting precedents for future institutions. They demonstrated the potential for a single institution to stabilize a nation's currency, preventing devaluation. They also showed how to manage credit and foster economic growth, which was crucial for development. The rise of central banks coincided with a period of significant expansion in global trade and commerce, facilitating international transactions. This underscored the need for institutions capable of facilitating these activities and ensuring smooth operations. The world was becoming increasingly interconnected, with trade routes spanning continents. Central banks emerged as crucial players on this new global stage, shaping the future of international finance. Amidst this backdrop of financial innovation, the Rothschild family rose to remarkable prominence. Mayer Amschel Rothschild, the patriarch, established a banking business in Frankfurt in the late 18th century. He had 5 ambitious sons. He strategically placed them in major European cities to expand their influence. These included London, Paris, Vienna and Naples, key financial hubs. This strategic dispersion allowed the family to build an unparalleled financial network. They facilitated trade and finance across borders, revolutionizing the industry. The Rothschilds financed governments and burgeoning industries. They funded major infrastructure projects like railroads, transforming economies. Their wealth grew exponentially alongside their influence. They became known for their exceptional financial acumen and discretion. They cultivated relationships with powerful individuals and influential institutions. The Rothschild name became synonymous with immense wealth and power in 19th century Europe. However, their story is not without its complexities and controversies. Conspiracy theories often portray the Rothschilds as puppet masters controlling central banks, suggesting they have an unseen hand in global finance. These theories allege that the family manipulates global finance for their benefit, orchestrating economic events from behind the scenes. However, these claims are not supported by credible evidence and lack substantial proof. They rely heavily on anti-Semitic tropes and stereotypes that have been debunked over time. These harmful tropes have long been used to demonize Jewish communities, perpetuating dangerous myths. It's important to approach such claims with a critical eye and a demand for verifiable evidence. Modern central banks are not controlled by any single family or entity, but are complex institutions. They operate within strict legal frameworks and regulations. They are accountable to governments and the public, ensuring a system of checks and balances. The Federal Reserve, for example, is subject to congressional oversight and scrutiny. Its activities are regularly audited to maintain transparency and accountability. Transparency is paramount in ensuring public trust in these vital institutions, fostering confidence in their operations. Claims of shadowy family dynasties controlling central banks are unfounded and misleading. They distract from the real issues facing our global financial system, which require serious and informed discussion. Thanks for joining me on this historical journey. If you enjoyed this trip back in time, don't forget to like, share and subscribe for more fascinating history bites. Until next time, keep exploring.